Greetings to all of you from the Midwest of Europe. I'm Norman Rentrop from Bonn, Germany. Thank you very much for writing your shareholder letter in such a way that we feel treated as partners. Warren, in the shareholder letter, you ended with your thoughts on managing Berkshire Hathaway in the future. May I ask you, how do you train your successors? What do you tell them? How do you summarize to them what is important to you? And how, if you were able to do so, how would you measure whether or not they have lived up to your expectations?
Well, that's a good question, and I think actually in reading that letter, that's part of the reason it's written is to convey not only to our partners, our shareholders, but also to our managers and anybody else in the public, what Berkshire is all about. This meeting, in terms of what we do, is intended to give a personality and a character to Berkshire. And we don't say it's better than anybody else's necessarily, but we do think it's us. And we think we want managers to join us who believe in the sort of operation we have, a partnership with shareholders, a lifetime commitment to the businesses. We want those people to join us. We want what they see after they join us to underscore the values we have. So everything we do, we hope is consistent with what most people would call a culture at Berkshire. So that the written word, what they see, what they hear, what they observe, and that is training in itself. It's the same sort of training you get as a child. I mean, when you are in the home, you're learning something every day by the behavior of these terribly important people, these big people that are around you. And a home has a culture, a business has a culture, to some extent a country can have a culture. And we try to do everything that's consistent with that. We try to do nothing that is inconsistent with that. And believe me, if you're a bright business Berkshire manager, and they are bright, they buy into it to start with. They see that it works, and it doesn't require formal lessons or mentoring or anything of the sort. I mean, if you talk to our Berkshire managers, you would find that they think consistently with how, in effect, Charlie and I think. There are plenty of people that don't, and they don't join us. I mean, we hear all the time from people. I've got one coming in a little while, actually, that nothing's going to come of it because this guy has his brain processes things different than mine does, and I'm kind of interested in learning about his business, so we'll get together. But it wouldn't fit. It would just not. It would be a mismatch. And the nice thing about it is our culture is so well defined that there aren't many mistakes in terms of people entering it or behaving in a way inconsistent with it. So I don't think there's any formal training necessary. I mentioned in the annual report the fact that if I die tonight, there are 3 obvious candidates to take my place. Now the board knows which one of them they would agree on tonight. Might be different 3 years from now. But any of those 3 would not miss a beat in terms of stepping in to the culture that I hope we have here, because it's theirs too. Charlie?
Well, if Warren has kept the faith until he's 75 years old in maintaining a certain kind of culture and a certain way of thinking, do you really think he's going to blow the job of passing the faith on? What could be more important in terms of his duties in life?
Yeah.
You all have something more important to do than worry about the fact that the candle is going to go out at Berkshire just because some people die. This is a a place where the faith is going to go on for a long time. And of course, at headquarters, we aren't training executives. We find them. And they're not hard to find. You know, if a mountain stands up like Everest, you don't have to be a genius to recognize that it's a high mountain.
Okay, number 4.
Warren and Charlie, I want to thank you for putting a once obscure Midwestern city on the map last year with your acquisition of Pete Legal's company, Forest River. I'm Frank Martin from Elkhart, Indiana, the RV capital of the world.
We're glad to have you here, Frank. Frank has just brought out a book, incidentally, that's a history of some of his annual letters. It's a good book, and I recommend you get it.
Thank you, Warren. I also want to thank you for your influence over Robin Williams and other Hollywood stars. Those of you who have seen the movie RV realize that Warren will go to no ends to promote the products of the companies he acquires.
A few people have already noticed that, actually, Frank.
On a more serious note, there's a small but growing trend in American business governance to move from plurality voting for directors to majority voting, along the standard in Great Britain. What do you see as the upside and downside of majority voting as it relates to raising the standard of ethics in the corporate boardroom?
Charlie, you want to take a swing at that?
I don't think it'll have any effect at all on ethics in the corporate boardroom. There get to be fashions in the government's subject. I think that the troubles in American corporations are not going to be fixed by something like that. All these reforms have to be considered in the light of the kind of people that are likely to be activist in using new powers, and that crowd is a mixed crowd, to put it gently.
The question in the boardroom is to what extent, and you have to understand it's partly a business situation, it's partly a social situation. The question is to what extent do the people that are participating there think like owners, and whether they know enough about business so that even if they're trying to think like owners, that their decisions will be any good. And Charlie and I have been on boards of companies with dual voting. Berkshire has that, although it's so minor that it doesn't really make any difference. But we've been on other boards, and I have never really seen any difference in behavior based on the nature of the votes that got them into the boardroom. But there's an enormous difference. I think you'd be blown away if you watched boardrooms over the years. There's just an enormous difference in terms of really the business savvy of the people in the room, the degree to which they are thinking like owners as they go along. I've seen no, I don't know that dual voting or the lack of dual voting really is going to have very much to do with that. The key, I've mentioned it in the past, there's all these fashions, as Charlie says, in corporate governance, but the job of the board is to get the right CEO to prevent that CEO from overreaching, because sometimes you have some people that are very able, but they still want to take it all for themselves. But if they take nothing and they're the wrong CEO, there's still a disaster. So low pay itself is not the criteria. But you want the right CEO, you do not want them overreaching, and then I think the board needs to exercise independent judgment on important acquisitions, because I think CEOs, even smart CEOs, are motivated frequently in acquisitions by other than rational reasons. And in those three areas, American directors I don't think they've given a tremendous account of themselves in recent years, whether at dual system places or otherwise. The only cure to better corporate governance, in my view, is that if the very large shareholders start really zeroing in on whether those questions I just mentioned are being addressed properly. If they go on all these peripheral issues, they have a lot of fun and they get in the papers. They have little checklists and they can issue grades and all that. It isn't going to do anything in terms of making American business working better. But if the 8 or 10 largest shareholder groups, if the really large institutional investors say, this compensation plan doesn't make any sense and we're not voting for the directors, and here's why we're not voting for the directors, you'd get change. But so far they've been unwilling to do that. It takes the big shareholders. It's not going to be done by any coalition of small shareholders or people sticking things on ballots. But the big shareholders of this country, basically some of them have farmed out their voting even. I was amazed to find that out, that a number of very large institutional investors have actually just turned their voting process over to somebody else. They don't want to think like owners, and we all bear the penalty for that. Number 6.
Hello, my name is Andy Pollan from Adrian, Michigan. Thank you once again for having me to Omaha. My question is for Warren, but Charlie, please add your thoughts as well. Warren, I've heard you say many times that you don't understand technology and that you rely on Bill for that, and that's fine. And I see from this year's movie that you're learning, so that's good.
Slowly.
I'm also curious to hear what you've learned so far about the other information technology companies such.
Charlie and I have circles of competence that extend to evaluating a number of types of businesses, and there are a whole lot of businesses that we won't be able to evaluate. Some of them I think very few people can evaluate. I mean, you get outside of you just get into businesses where the future is so likely to be different than the present that maybe there's a few people who have great insights on it, but we sure don't. We are best at the businesses where we can come to a judgment that they're going to look a good bit like they do now, 5 years from now, 10 years from now. They'll be bigger, they'll be doing different things, but the fundamentals will be the same. This car will be a bigger company 5 years from now, maybe a much bigger company, and we may get a chance to do interesting acquisitions. But what you saw there, the fundamentals won't change. The way the people think won't change. I can name a number of businesses that are bound to change dramatically. I mean, when you think of how much the telecom business, for example, has changed over the last 15 or 20 years, it's startling. Even with hindsight, it's a little hard to figure out, who was going to make all the money and so on. There's just games that are too tough. Charlie says, we've got 3 boxes at the company: in, out, and too hard. And a lot of things end up in the too hard pile, and it doesn't bother us. We don't have to be able to do everything well. If you go to the Olympics, if you can run the 100-meter well, you don't have to throw the shot put. Some other guy can throw the shot put and you'll still get a gold ribbon, if you run the 100-meter fast enough. So we try to stay within the circle of competence. Tom Watson Sr., I think it was Sr. Yeah, Tom Watson Sr. many years ago said, I'm no genius, but I'm smart in spots and I stay around those spots. Well, that was pretty damn smart, and we have found a lot of our managers who don't think, they can solve every problem in the world, but they run their businesses extraordinarily well. I mean, you do not want to, Frank Martin mentioned Forest River, you do not want to go and compete with Pete Legal in his business. He's going to kill you, and he's very, very, very good. But he doesn't come around and try and tell us how to run the insurance business, because that's not his game. We look for people that are very good at things they understand, and we don't get any inferiority complex at all about the fact that, you mentioned Intel, I believe. I was virtually there at the birth of Intel because I was on the board of Grinnell, and Bob Noyce was the chairman of the board of Grinnell. And we bought at Grinnell, $300,000 worth of their original debentures. And, I knew Bob. I thought he was a very, very smart guy. But I wouldn't have had the faintest idea how to evaluate the future of Intel then. And I really don't have it now, And I think they probably had a few surprises themselves in the last few years with AMD and what's been happening in their business. But what that's going to look like in 5 years, I don't have any idea. And I'm not so sure if you're in the industry, you'd know exactly what it was going to look like in 5 years. Some businesses just are very, very hard to predict. Charlie?
Yeah, one of the foreign correspondents last year, after looking at us carefully, said in effect, "You guys don't seem smart enough to do so much better than other people as you're doing."
Was he looking at me or you, Charlie?
Both. Have you got an explanation? And we said, we know the edge of our competency better than most people do. It's a very useful thing to know the edge of your competency. And I always say it's not a competency if you don't know the edge of it.
I'll have to think about that a little bit. Bill will explain it to me later. Area 7, please.
My name is Elliot Samuels. I'm from New York City. Thanks to high energy prices, other factors, Russia has been one of the best performing markets recently. The country's financial condition has stabilized since the 1990s. A fledgling middle class is taking shape as personal incomes grow. And there are also risks, political, legal, risk to minority investors. But there are also potentially great values among second-tier companies there. I was wondering what needs to happen in Russia for you to invest there, whether for Berkshire or for yourself, and what kind of companies would interest you there?
That sounds like you may own a few Russian stocks yourself. I would, as you know, in 1998, Walter Wriston's don't default in 1998. In Russia, at least, he was proven wrong. And Charlie and I inherited a business at Solomon that was in the oil business, big time out in Siberia. And there came a time when we got to dig the holes. We sent the money in, and as long as we were drilling, we were welcome. And then we wanted to start taking the oil out. After our money had been used to drill the holes, they weren't quite as friendly. In fact, it was really kind of extreme what took place with us. So having had a few experiences like that, it might take us quite a while before we wanted to sink a lot of money into Russia. It may be different now, but I don't think it's any certainty. I had breakfast in Sun Valley 3 years ago, this July, I believe it was, with Kordakovsky, and we had a translator there, and he talked to me about whether he was thinking about listing Yukos on the New York Stock Exchange, but he said, it would require registering with the SEC or something, and he wasn't sure whether that would be too dangerous. Well, I don't think he listed there, but he went back to Russia, and he's been in jail now for, just about ever since. And Yukos was put into bankruptcy with tax claims, and I just think it's a little hard to develop a lot of confidence that the world has changed permanently there in terms of its attitude toward capital, and particularly toward outside capital. Charlie, what are your thoughts?
Yeah, the situation reminds me a little of polypetroleum, which years ago was much traded in Los Angeles. And the saying always was, if they ever do find any oil, that old man will steal it. And I'm afraid we have some of that problem in many of the countries in which we're seeking for oil.
Didn't we really have the livelihood of our guys threatened over there, Charlie? I think we sent in some people to get out the equipment, and they said if they sent in the people to get out the equipment, not only would the equipment not get out, but the people wouldn't get out. So we understood the situation. That was not that long ago.
No.
Number one again.
This is Phil McCall from Connecticut. I wonder, it's been some time since you commented on Coca-Cola, and now that you're off the board, I wonder if you feel free to comment on it.
Yeah, well, I won't make particularly different comments than from when I was on the board, but Coca-Cola is a fabulous company. Coca-Cola will sell over 21 billion cases of various products, more Coke than anything else, around the world this year, and it goes up every year. It's interesting, the stock in 1997 or 98, whenever it was, sold over $80 a share when the earnings were, I don't remember what, $1.50 a share or something like that. And the earnings then were not as of good quality as the earnings are now, when they were $2.17 or something like that. And every year they account for a little greater share of the liquids consumed by people in the world. They make fabulous returns on invested capital. It's a business that has, exclude the bottling part of it, it has 5 or 6 billion of tangible assets and makes a similar amount. So there are not lots of big businesses in the world that earn 100% pre-tax on tangible assets. And it'll be a great business, and it's been a great business. The stock got to what, in retrospect, clearly was a ridiculous level, but you can't hold the present management, Neville Isidel, responsible for that. And he, if the company sells 4 or 5% more units this year than last year, and the population of the world goes up 2%, it just means that more people are putting that particular source of liquid down their throats than the year before, and that's been going on ever since 1886. So it strikes us as a really wonderful business that sold at a very silly price some years back, and you can definitely fault me for not selling the stock. I always thought it was a wonderful business, but clearly at 50 times earnings, it was a silly price on the stock. So we like it. We'll own it 10 years from now, in my view. Charlie?
No more.
Dear Warren and Charlie, I'm Oliver Krautschat from Frankfurt in Germany. Here's a question to the Silver King. Some commodity investors give you as a reference as one of the largest owner of physical silver. Could you please clarify what kind of exposure you or Berkshire currently have in silver? And further, could you please help us to understand how you determine the value of a non-interest bearing precious metal?
Do you have any silver on you, Charlie? We had a lot of silver at one time, but we don't have it now. The original decision, my decision, was that the production of silver and the reclamation of silver, I don't remember the numbers exactly now, but they were running perhaps 100 million ounces or thereabouts less than the consumption. And now a lot of consumption has gone down in photography, but that's where the reclamation was too, so that those tended more to balance each other out. I haven't looked at the figures for the last year or so, but silver was out of balance. Now, on the other hand, there were enormous quantities of silver above ground, and there were huge quantities of silver that could possibly be removed from other uses, perhaps in jewelry and all kinds of things that could conceivably add to supply, as they did in the early 1980s when the Hunt Brothers thing took place. But overall, silver was being produced and reclaimed at a lesser rate than it was being consumed, and added to that was the fact that there are relatively few pure silver mines. Silver is largely produced as a byproduct of copper and lead and zinc, and so that it was not easy to bring on added production. So all of that added up to the fact that I thought that silver would get tight at some point. And as I said, I was early in that conclusion, and I was early in selling. So we have no silver now, and we did not make much money on it. And you're right that it doesn't earn anything. So you sit with it. It's not like It's not like sitting with a stock where in most cases earnings are piling up for you. You have to hope that a commodity moves in price because it is not producing anything as it sits there looking at you, and that's one of the drawbacks of commodities. Charlie?
We didn't get where we are by owning non-interest bearing commodities. I don't think it's a big issue around here.
We actually owned oil at one time too, didn't we? But we didn't make much money out of it. We made a little money.
No, you made quite a bit out of oil. Yeah. But, you know, it's a good habit to trumpet your failures and be quiet about your successes.
Yeah. Well, we have more to trumpet than we have to be quiet about. How about number 4?
Good morning. My name is Glenn Strong. I'm from Canton, Ohio. I'm an optimistic person, and I'm sure it would be more enjoyable to discuss the Chicago Cubs' march to the World Series.
You are optimistic. But everybody has a bad century now and then, as somebody said about the Cubs.
However, I have an information deficit on a certain topic that I hope you can fix. Please gaze into your crystal ball. As an investor, I want to know how to address the risk of nuclear terrorism in the United States. Consider a scenario where terrorists have detonated a nuclear device in a major U.S. city. I know there would be a terrible cost in human lives. Gentlemen, what would happen to our economy? How would it respond? How resilient would it be? Thank you.
Well, it would certainly depend on the extent of it, but if you're asking how to profit from that, there's probably some dealer that will sell you mortality derivatives, but I'm not sure that's what we would be thinking about that. No, I agree with you, I couldn't agree with you more about that being the ultimate problem of mankind, not necessarily a terrorist type usage of, but a state-sponsored usage of weapons of mass destruction, and it will happen someday. The extent to which it will happen, where it will happen, who knows? But we have always had evil people. We've always had people who wish evil on others, and you know, thousands of years ago, if you were psychotic or a religious fanatic or a malcontent, and you wished evil on your neighbor, you picked up a rock and threw it at him, and that was about the damage you could do. But we went on to bows and arrows and cannons and a few things. But since 1945, it's the potential for inflicting enormous harm on incredible numbers of people has increased, you know, at a geometric pace. So it is the problem of mankind. It may happen here, it may happen someplace else. People say sometimes they say, well, you know, if we solve poverty, we'd solve this. Well, I would just remind you that nuclear weapons have only been used twice, and those were by the richest country in the world, the United States, in 1945. So people will justify their use under some circumstances if they feel threatened. They will justify them for religious reasons. They will do all kinds of crazy things. And what holds it in check is the degree to which the lack of knowledge of how to do it is controlled, and the degree to which the materials are controlled, and which the deliverability is circumscribed. And we're losing ground on all of those fronts. The knowledge is more widespread. You know, the possibility of getting your hands on materials, you know, the Dr. Kahns of the world and so on, has increased, and it will be it's a real problem. But we won't be thinking about what Berkshire did that day in the stock market. And I don't know. I don't know how money attacks that. I mean, I've always held that as the top priority. I think should be the top priority for a philanthropy in my particular case. But it's a very difficult. It's a worst case problem. You know, you have 6 billion people in the world, and if a certain percentage of them who are one way or another a little crazy or very crazy, and some of whom, and that craziness would manifest itself by trying to do great harm to a lot of people. and it's only one of them has to succeed. I don't know how many we've intercepted over the years. I'm sure we've intercepted a lot of incipient ones, but it is a worst case problem, and one will succeed at some point, and it may be state sponsored, it may be terrorists. But Berkshire is better set to survive than anybody else, but it won't make much difference. Charlie?
Well, I think that the chances we'll have another 60 or 70 years with no nuclear devices used on purpose is pretty close to zero. So I think you're right to worry about it, but I don't myself think there's much that any of us can do about it except to be as sensible as we can and take the consequences as they come.
The only thing you can do about it, but you only have one vote, is to elect leaders who are terribly conscious of the product and problem and who devote a significant part of their thought and energy into minimizing it. You can't eliminate it. The genie is out of the bottle, and you would like to have the leaders of the major countries of the world regarding it as a primary focus. Actually, in the 2004 campaign, I think that both candidates said it was the major problem of our time, but they probably suffer from the same feeling that I do, that it's very hard to address. Number 6.
Good morning. My name is David Saber, shareholder from Minneapolis, Minnesota. Looking for some advice you might give the young professionals here. I could be classified as one of those helpers you describe in your annual report. In fact, most of my friends are helpers, and some could be classified as super helpers. Most would love to step out and explore some of their more innovative ideas, innovative business models, strategies, and things of that nature. But at the risk of giving up a significant salary, health insurance, flights, all the ridiculous corporate perks that some of us young professionals earn, what advice would you have in us into pursuing those dreams?
Charlie, what do you think?
Well, there's certainly a lot more helpers in the economy than there used to be. And the ones that come here tend to be the very best of the helper class. So I don't think you should judge the helper class by those you meet here. We get the best of them. And as to what the young helpers ought to do so that they'll eventually be like Warren Buffett, I would say the best thing you can do is reduce your expectations.
I think I've heard that before. Well, it is, as I wrote about, and I'm trying to tweak the system a little bit, but it is an interesting business in that the activities of the professionals are self-neutralizing, and if your wife is going to have a baby, you're going to be better off if you call an obstetrician probably than if you do it yourself. And if your plumbing pipes are clogged or something, you're probably better off calling a plumber. Most professions have value added to them above what the layman can accomplish themselves. In aggregate, the investment profession does not do that. So you have a huge group of people making, I put the estimate as $140 billion a year, that in aggregate are and can only accomplish what somebody can do, in 10 minutes a year by themselves. And it's hard to think of another business like that, Charlie.
I can't think of any.
No. But it's become a bigger and bigger business. And as I've pointed out in the report, the main thing that's been learned is that the more you charge at least temporarily, the more money you bring in. That people have this idea that price equals value. It's useful to get into a business like that. Sometimes if I'm talking to the people at a business school, I ask them to name me a great business. And of course, one of the great businesses is a business school, because basically the more you charge, the more your prestige is to some extent. And people think that a business school that charges $50,000 a year of tuition is going to be better than one charges $10,000 a year of tuition. So there's some of that well, there's a lot of it that's gotten into the investment field recently, and you now have certain large portions of investment management that are charging fees that in aggregate cannot work out for investors. Now, obviously some do, but you cannot be paying people 2% and 20% where they get it in the good years and they fold their partnerships and start another one if they have a bad year and that sort of thing. You can't have that coming out of an economy that's only going to produce, we'll say, 7% or something like that a year for investors, and have people net better off. It isn't going to work. And then the question that you will have is, how do I pick out the few exceptions? And everyone that calls upon you to sell you this will tell you that they are an exception. And I am willing to bet a significant sum of money. We'll put it up to anybody who wants to name 10 partnerships that are $500 million or more of management and pit those after fees against the S&P over a 10-year period. It gets away from the survivorship bias and all that kind of thing. And it isn't going to happen. But a few will do well. They're bound to do well. And I think I do know how to pick a few that will do well. I mean, I did it in the past when I wound up my own partnership in 1969. I told people to go to either Bill Ruane or Sandy Gottesman, and that would have been a very good decision, whichever place they went. So if you know enough about the person, know enough how they've done it in the past, know enough about their personality and honesty and a whole bunch of things, I think that occasionally you can make a very intelligent choice in picking an investment manager. But I don't think you can do it if you're running a pension fund in some state and you have 50 people calling on you. You're going to go with the ones that are the best salespeople and not the ones that are the best investors. Charlie?
Yeah, on that state pension fund investment subject, I think it ought to be a crime to entertain in any way a state pension fund official, and I think it ought to be a crime, if you are a state pension fund official, to accept the entertainment. It's not a pretty scene, a lot of investment management in America now. And human nature being what it is and the amounts of money being what they are, I don't think much is going to be improved.
Well, we wanted to leave you in a good mood for lunch, so we will break now and we'll come back in about 45 minutes or so. And those of you who are in the other rooms, by then the crowd thins for some unexplainable reason, and you can all join us here in the main room, and we'll be back in about 45 minutes. Thank you.
Hi, I'm Mike Kelly from Iowa City. We've heard a bit about ISCAR today. Could you tell us some things about some of the other acquisitions of the past year?
What would you like to know, Mike? I mean, we described them a bit in the annual report, but...
Right. I believe since the annual report there have been a couple of others. Russell, for instance.
Yeah, Russell is in the works. There's just been a proxy statement that isn't out yet, but it's been filed with the SEC. You can get a copy of the filing, but that is one in process, and is probably a couple of months off from actual completion. I described the Business Wire situation in the annual report, where I got a letter from Kathy after reading reading a Wall Street Journal article, and they just all sort of pop up. Medical protective. I think I suggested to Jeff Immelt at GE that if I knew they were interested in doing things with their insurance assets, and I suggested that was one portion of their insurance assets that Berkshire would have an interest in, and he and I met one time. We made a deal on that one. Pacific Corp. That originated with Dave Sokol and the people at Scottish Power. I'm not even exactly sure what the sequence was, but the one thing we haven't done is we haven't participated in any auctions. I get books occasionally on various businesses, and the projections are just plain silly in these books. I mean, maybe that's why they don't sign their names in the books, the people that write them, because they'd be embarrassed about the projections they put forth. I would just love to meet the people that write those investment banking books and make them a bet on the earnings that they project 4 years out. I would win a lot of money over time. They wouldn't be met. But we get the calls occasionally from the people that care about where their businesses end up. We're going to close on Applied Underwriters in just probably a few days, and those are two terrific guys. Built it up from absolutely nothing. Actually bought a tiny business here in Omaha, as I explained in the report. It's why it's here. But they wanted to come with Berkshire. They think they're keeping 19% of the company. They think their own future will be the best in many ways, including financially, I'm sure. Of being associated with us. They feel it's the best place for the people, have the most opportunity to grow, and they came to us directly. And, I don't know how many stories you read about a $4 billion deal as appeared today in connection with this car, where it doesn't say anything about an investment banker on either side, but you'll see more of those, I think, with Berkshire over the years. Charlie, do you have anything particular to add on our acquisitions recently?
Well, the interesting thing about it to me is the mindset. With all of these new helpers in the world, they talk about doing deals. That is not the mindset at Berkshire. We are trying to welcome partners. It's a totally different mindset. The guy who's doing a deal, he wants to do the deal and unwind the deal and not too far ahead and make a large profit, etc. And that's not our mindset at all. We like the things that we can buy and that never leave us, and we like the relationships that last and are fruitful, not just for us, but for the people working there and the customers and everybody else. I think our system is going to work better long term than flipping a lot of deals. And we have so many new deal flippers in the game that I think they're going to get in one another's way. In other words, I don't think there's enough money out there to have all this new class make all the money they expect to make on a permanent basis, just flipping.
They'll make it on fees.
Warren reminds me, once I asked a man who just left a large investment bank, and I said, how does your firm make its money? He said, off the top, off the bottom, off both sides, and in the middle.
I know which firm he's talking about, too.
That's not our culture, and a lot of you have been here so long, you can see that's not our culture, but in the end, it may be that Omaha will do better than Wall Street.
Number 5.
Hi, my name is Jeremy from San Diego. And first of all, I want to thank you all for the tremendous impact that you've had on my career as a professional investor. My question is also about the newspaper industry that the gentleman earlier touched on. And for some of the same points that you brought up, some of the largest newspaper stocks seem to earn an incredible return on invested capital as compared to a lot of the businesses in the S&P 500. My question is more specifically related to valuation. If either of you were looking at a newspaper stock today and watching them fall, as some people may categorize falling knives, what would you use to determine, or how would you determine a very comfortable margin of safety to protect yourself against the deteriorating aspects of the newspaper industry?
Yeah, well, the question is what multiple should you pay for a business that's earning $100 million a year, called it pre-tax, whose earnings are going to go down 5% a year compared to what you should pay for a business that's earning $100 million a year whose earnings are going to go up 5% a year. And I would say that, I'm not saying that those are percentages I predict on newspaper companies, but certainly newspaper companies face the prospect of their newspaper earnings eroding. And we've seen some of it already. We see every trend pointing in that direction. We own a newspaper ourselves, and I do not think the circulation of our paper will be larger in 5 years, and I don't think the advertising pages will be greater. And I think that's true even of newspapers that operate in more prosperous, or actually more growing, I should say, areas of the country than we do. So, but I don't think most owners of papers still have quite gotten to the point where they start projecting out declining earnings. Certainly multiples on newspaper stocks are unattractively high if you would see some decline like 5 or 6% a year in earnings occurring from this point. They're not cheap enough to compensate for that sort of erosion in earning power. And then you face the added risk that they may have a sort of a perception lag, and that they may continue to use some of that money to buy other newspapers at prices which again don't make much sense. It's pretty hard in a declining business to buy things cheap enough to compensate for the decline. People in the business always tend to think that they're seeing the first robin, or something, and that it's going to get better. And I would say the newspaper business, the decline, if anything, has accelerated somewhat. When they take people out to the cemetery, they're taking newspaper readers, and when people graduate from school, they're not gaining newspaper readers, and that may not change things overnight, but it goes in the wrong direction. And the less the readership, the less compelling argument to have to advertisers. So that virtuous circle where everybody read a paper because every ad was in it, and every ad was in it because everybody read a paper, that virtuous cycle is going in the other direction now. And I don't think present prices for papers compensate for that. And you are now hearing from a couple of guys that just love newspapers. We think newspapers are indispensable, right, but we don't have we have less company in that view than before. I read 5 newspapers every day. Charlie probably does about the same. And
more.
Yeah, well, it shows too. We couldn't live without them, but a lot of people can, and more people can every day. And we love the idea of buying newspapers. We traveled to Cincinnati and sat in cheap hotels and tried all kinds of things to buy newspapers. And we thought, incidentally, we loved them as products, and we thought they were the greatest of businesses, the ultimate bulletproof franchise. But it became apparent we were wrong. We still love them as products, but we were wrong about the bulletproof franchise. And when we got to believe our eyes in terms of what we're seeing in that world. Charlie?
Yeah, I have an even greater sin to admit to. I once thought General Motors was a bulletproof franchise. But we have a wonderful way of coping with a lot of these things. We have this too hard pile. I don't know if Warren is buying General Motors or not, but I have a good guess. And it's just too hard. If something is too hard to do, we look for something that isn't too hard to do. What could be more obvious than that?
It may mean that we don't do very much.
Yeah.
We won't get into some specifics. I don't think anybody has watched the newspaper business much more carefully than Charlie and I have for really 50 years. We always talked about every paper in the country and the potential for buying it and all of that sort of thing. And it was easily understood. I mean, it was about as easy a business economics problem as you could imagine. And we slowly woke up to change on it. Actually, I wrote in the 1991 annual report, the newspaper, the preprints of the world, started turning the newspaper into a wrapper. It contained a whole bunch of things that could have been contained in some other package. Now, your newspaper wasn't reproducible in some other package, but this thing was carrying around a bunch of preprints. Now, the question are there easier ways to carry around those preprints? But there was nothing magical about the paper except it got inside the house and brought the preprints inside the house. And as the newspaper lost penetration, it became a somewhat less efficient way of getting things into the house, and other ways became more efficient at getting things into the house. And so there's these things. It's not a hard business to understand. And it has been interesting to me to watch both owners, direct owners, and investors in the business sort of resist seeing what's right in front of them. It went so long the other way that you couldn't make a mistake buying a monopoly newspaper. Nobody ever made a mistake buying one, up until 1975 or 80 or something like that.
Yeah. If the technology had not changed, they'd still be impregnable franchises. But the technology did change. Fortunately, carbide cutting tools appear to have no good substitute.
It's a lot better business over time if you have the right management. It takes very good management. Nice thing about the newspaper business 30 or 40 years ago, it took no management at all. I mean, if you had an idiot nephew, you'd be a perfect, or a network television station. I mean, they were going to make money no matter what happened. They were going to make more money if they were under good management. I mean, if Tom Murphy was running your television stations, you were going to do much better than if you had your nephew doing it. But the nephew would have done all right. Number 7.
My name's Simon Dennison Smith from the UK. My question is this. If you were starting out today with $1 million, with a vision of building a business with 20% average growth in value over 40 years, what type of investments and investment strategy would you look to make in the first 5 years?
Well, it's somewhat interesting that we formed the first partnership 50 years ago, 2 days ago, Thursday, on May 4th, 1956, which was 105,000. That's my sister clapping. She was in the partnership. We would, if Charlie and I were starting all over again and we were in this, Charlie would say we shouldn't be doing this, but if we were to succumb to Satan and engage in the same kind of activity, we would, I think, be doing something very similarly. If we were investing in securities, we would look around the world and we would look at a Korea, and Charlie says you can't find 20 of them, but you don't have to find 20 of them. You only have to find one, really. You do not have to have tons of good ideas in this business. You just have a good idea that's worth a ton occasionally. And in securities, we would be doing the same thing, which would probably mean smaller stocks. It would mean smaller stocks because we would find things that could have an impact on a small portfolio that will have no impact on a portfolio the size of Berkshire. If we were trying to buy businesses, we'd have a tough time. We would have no reputation, so people would not be coming to us. we'd be too small a player if you're talking about $1 million. So we would not have much success, I don't think, with small amounts buying businesses. Charlie started out, in real estate development because it took very, very little capital, and you could magnify brain power and energy, or I should say brain power and energy could magnify small amounts of capital in a huge way that was not true in securities. My natural inclination was to look at securities and just kind of do it one foot in front of the other over time. But the basic principles wouldn't be different. I think if I'd been running a partnership a couple of years ago with a small amount of money, I think I'd have probably been 100% in Korea. And, I would be looking around for something that was very mispriced and that I understood. And every now and then that's going to happen. Charlie?
Well, I agree with that. The concept that you're likely to find just one thing where it'll make 20% per annum and you just sit back for the next 40 years, that tends to be dreamland. And in the real world, you have to find something that you can understand that's the best you have available. And once you found the best thing, then you measure everything against that because it's your opportunity cost. That's the way small sums of money should be invested. And the trick, of course, is getting enough expertise that your opportunity cost, meaning your default option, which is still pretty good, is very high. And so the game hasn't changed at all in terms of its basic arithmetic. And that's why modern portfolio theory is so asinine.
It really is, folks.
Yeah. When Warren said he would have been all in one country, that's pretty close to right. He wouldn't have quite done that when he had the partnership, but he would have been way more concentrated than is conventional if you listen to modern portfolio theory. Most people aren't going to find thousands of things that are equally good. They're going to find a few things where one or two of them are way better than anything else they know. And the right way to think about investing is to act thinking about your best opportunity cost. A freshman course in economics everywhere in the basic textbook, it just hasn't made its way into modern portfolio theory.
We don't get asked to do book reviews.
I'm Bob Klein from Los Angeles. You've so eloquently stated that you can't see who's swimming naked until the tide goes out. Could you discuss the issue of trying to employ a rational decision-making process in investing or in business generally, as opposed to focusing on outcomes or results of just a few instances or over a short period of time? For example, it may not be a good idea to underwrite some insurance policies if competition has lowered the premiums too far. And likewise, in the stock market, momentum investors may get good results for a while, but buying high and trying to sell higher isn't a good long-term strategy. So I'd just like to hear you guys provide some detail on the importance of using an effective decision-making process, even though it may lead to some bad outcomes and underperformance in the short run.
Yeah, well, Ben Graham said long ago that you're neither right nor wrong because people agree with you or disagree with you. In other words, being contrarian has no special virtue over being a trend follower. You're right because your facts and reasoning are right. So all you do is you try to make sure that the facts you have are correct, and that's usually pretty easy to do in this country. I mean, the information is available on all kinds of things. Internet makes it even easier. And then once you have the facts, you got to think through what they mean. And you don't take a public opinion survey. You don't pay attention to things that are unimportant. I mean, what you're looking for is things that are important and knowable. If something's important but unknowable, forget it. I mean, it may be important, to know whether somebody's going to drop a nuclear weapon tomorrow, but it's unknowable. It may be all kinds of things. But so and there are all kinds of things that are knowable but are unimportant. In focusing on business and investment decisions, you try to you narrow it down to the things that are knowable and important, and then you decide whether you have information of sufficient value that, compared to price and all that will cause you to act. What others are doing means nothing. It's like what Graham writes in Chapter 8 of The Intelligent Investor, that the market is there to serve you and not to instruct you. That's of enormous importance. When people talk about momentum in stocks or charting or any kind of things like that, they're saying that the market is instructing you. The market doesn't instruct us. The market is there to serve us. If it does something silly, we get a chance to do something because it's doing something silly, we do it. But it doesn't tell us anything. It just tells us prices. And if the price is out of line with where the facts and reasoning lead you, then action is called for. And if it doesn't, you forget it and, go play bridge that day and the next day see whether there's something new. And the nice thing about it is there always is something new. I mentioned the LTCM crisis. We on Sunday from people that had portfolios that were in trouble. Now, I will tell you that if you can make a lot of money on Sunday, you may not get a chance very often, but any calls you get on Sunday, you're probably going to make money on. Things are really screwed up if you're getting calls on Sunday. And all you have to do is make sure that you're the callee and not the caller on Sunday. But if you get those calls, you get a call on a Sunday and somebody says that the off the run is trading 30 basis points away from the on the run, all you have to do is decide how you handle that particular piece of information, whether it's correct in the first place, but how you handle that piece of information, whether you can play out your hand. You never get in a position, obviously, where the other fellow can call your tune. You have to be able to play out your hand under all circumstances. But if you can play out your hand, and you've got the right facts, and you reason by yourself, and you let the market serve you and not instruct you, you can't miss. Charlie?
Well, I would say some of you probably can miss.
I would say Charlie can't miss, I'll put it that way. He'll agree with that. You have anything further to add on? Okay. At least I've got him off that previous subject. Number 11.
Hello, I'm Randall Bellows from Maryland. I would like to know how you would look at the Berkshire annual report. What numbers in the balance sheet or the cash flows would tell you that Berkshire is underpriced, and what numbers would you look at to determine if Berkshire is overpriced? Thank you.
Mm-hmm. We try to, and we take it very seriously. We try to put everything in that report that we would want to know if the positions were reversed. If I were sitting with all of my net worth in Berkshire and had been on a desert island for a year, and the manager was reporting to me about the business, we'd try to have that same information that I would want from him, and we try to present it to you in a way that's understandable. And we don't leave out things that we think are important. We try not to put, I mean, it runs about 76, I think, or maybe even 80 pages this year. I mean, you can drown people in information that really doesn't make much difference. But we've tried to organize it in a way by talking about these different groups of businesses. We try to explain how we think about it in terms of things like the amount of operating earnings we've generated and the investments we have. It's really as if it's a report that I was making to Charlie or Charlie would be making to me if one of us were inactive in the business and the other was running it. And so I think, I mean, it may take a few hours to do it, but I think if you regard yourself as a serious owner of Berkshire, it's really worth reading the whole report, thinking about what is there, what are these guys going to do with it, what are they trying to attempt, what are the odds they're going to be successful in in that attempt? What are they, what is it worth if they don't succeed very well in deploying additional capital? What might be the case if they were successful in deploying excess capital and incremental capital? But I can tell you that obviously we think it's very important. What counts is the kind of businesses we have, the kind of managers we have running those businesses, what those businesses are likely to earn over time. And we've expressed ourselves a little on that. And then what are the resources that are available to keep adding to that collection of businesses? What are the kind of businesses we are looking to add? And I think, I think you'll find the information that you need to evaluate Berkshire. And it's not you don't carry it out to 4 decimal places. Charlie and I, if we had to stick a number down on a piece of paper right now as to some pinpoint number, we wouldn't do it because we know that's impossible. But if we had to stick a number down, it'd be a different number between the two of us. It'd be a different number if I did it today from tomorrow, probably. But we'd be in the same ballpark. And we'd be looking at the same things. And the things we would be looking at, we report to you in that report. I would focus. The question of what Berkshire is going to be worth 10 years from now will depend on the earnings that we have developed, annual earnings that we've developed by that time, the quality of those earnings, the possibilities going forward from that point of those businesses, and the liquid assets we have. And we've worked on increasing both of those elements over the years, and we'll keep working on it. And it's a lot tougher in terms of percentage gains from this point forward than it was in the past. There's no way in the world that we can replicate what's happened in the past. It just won't happen. The question is whether we can do a reasonable job or not. Charlie?
Yeah, I generally try and approach a complex task like the one you presented by quickly disposing of what I call the no-brainer decisions, and meaning the easy ones. I think if you go through all the operating insurance that don't involve surplus cash and the insurance operations, that's the easiest valuation process in Berkshire. And the insurance operation is very interesting, and so is the process by which the huge amounts of excess cash are continually redeployed. But I would go at it in that sequence, taking the no-brainers first.
Number 12.
Hello, my name is Barry Steinhardt, shareholder from New York. My question relates to the Chapter 11 bankruptcy process. I know you have been active in the past in some activity in the bankruptcy court, and if you had thoughts on possible reforms in that area, if you believe that any reforms are necessary.
Well, that's a good question. Charlie's probably better qualified to answer than I am. I mean, we have bought Fruit of the Loom out of bankruptcy, and we have had some involvement in owning junk bonds. We think about the bankruptcy process, but in terms of the practicalities of improving on it, what do you think, Charlie?
Well, I think much of that is pretty horrible. You have a competition there where the courts themselves have gone into bidding contests to get bankruptcy business attracted, meaning that there are various courts that can handle bankruptcy cases, and they have found that if they develop a culture where they overpay a lot of people egregiously, they can attract more business. Lawyers, trustees, consultants, et cetera, et cetera. I find this so unpleasant to watch that I don't pay as much attention to bankruptcy as I probably should. I'm an old man and I don't like to have an upset stomach.
Well, we look at At least I do. I'm not sure about Charlie, but bankruptcies will be something that we will, one way or another, over the next 20 years, we'll have various ways of participating in. We bought certain of the bonds, for example, of Enron after they entered bankruptcy. We bought something called the Ospreys, and a complicated bankruptcy can offer opportunities for profit. Now, there's so many people looking at bankruptcies currently, or potential bankruptcies. It's a field that I would say does not have a lot of promise right now, but it has had promise in the past. We actually, in the Fruit of the Loom situation, I first went into that just by buying some Fruit of the Loom bonds when I had no notion that we might conceivably end up with a company. But I knew enough about it to buy the bonds, and Enron comes along and it's a big mess. The Penn Central came along 20-odd years ago and it was a big mess, and there was a lot of money made in the Penn Central simply because it was such a complicated mess. So anytime there's something big, complicated, there's certainly a good chance of mispricing. Now, lately the mispricing may be more on the high side than on the low side, but over time you're going to find there will be some attractive things to do in bankruptcy situations. We've had other bankruptcy situations where we've gotten involved in the process and then been outbid. It happened at Burlington and happened at Sitel, but we owned all the bonds at Sitel, so we came out fine. It's something to understand if you're in the business of buying investments or businesses. And I would say that, if we're around for another 10 or 15 years, that we'll do something or other, maybe substantial, in the bankruptcy field. The Enrons, the payment's still being made in various ways, but the Ospreys, which were kind of a complicated situation, the whole thing was complicated, but we didn't buy at the bottom or anything like that, but we considerably more than tripled our money in something that you could have put a fair amount of money in. So they can be interesting. Charlie, do you want to?
Well, I remember the Eastern Airlines bankruptcy, where there were a lot of employees and communities that would have been affected. And the courts in that case, I would say, abused the senior creditors horribly. And so it's a very interesting field.
Yeah, and it can be very unpredictable. In the Penn Central case, you had an incredible variety of claims. I mean, you had leased lines and you had all kinds of first and second liens and everything. And the judge, as I remember it, I may be wrong a little bit on the details, but as I remember, the judge just looked at this incredible, probably the most complicated bankruptcy that had come down the pike in the history of bankruptcy to that point. And he just said, this is just too damn complicated. I'm just sort of going to ignore the various priorities and all this. I'm just going to, perhaps they might call it substantive consolidation or something. I'm just going to put this all together, and I'm going to give you a quick, fast solution. And I think it was a very smart way to handle things, because otherwise I think Penn Central might still be going. But it wasn't what the book said would be done. Judges can determine things in a very big way. I remember when we were in Cincinnati on that newspaper case I mentioned earlier, I said to Charlie, a judge had stayed in order, I think, for a week or something like that. And I said to Charlie, how much power does a federal judge have? And Charlie says, well, for a while, as much as he thinks he has. I learned a lot out of that. Number 3.
Hi, it's Peter Webb here from London, UK. Your views on gambling are well known, and I think most people would agree that gambling is for the fiscally challenged. But when I look at the insurance industry, what I see as an industry, I can't even say it. I see an industry that's based upon probabilities and people not knowing those true probabilities, and money being made for the house in the same way as you see in a gambling market. So the question that I have for you is, how do you reconcile your views with gambling versus the insurance industry? And is the insurance industry for the fiscally challenged?
Yeah, well, gambling, I think the distinction that usually is made is that gambling involves creating risks that don't need to be created. I mean, if you want to go out and gamble on where a little ball is going to fall on a wheel that's revolving, that is not something that is a created risk. Whereas if you've got a home or a business, on a coastal area, the risk is there. It wasn't created intentionally. I mean, you can say you build in that place, and then the question is who bears it. So there's a transfer of, in the case of cat coverage, large existing risks as opposed to the creation of a risk that is not required. I mean, you can watch a football game without betting on it, but you can't live in a house, on a Florida coast without having a risk that your entire investment disappears. So that's the distinction, basically. I hope you're right that the house wins in both cases. And Charlie?
Well, I don't think I can add to that either. The whole concept of the house advantage is a very interesting one in modern commerce. A lot of the investment management operations, which were not ordinarily spoken of in the past in croupier terms, but the terms of a lot of private equity investment now, I think the proprietors of the partnerships are taking a house edge that looks a lot like the rake of the croupier in Monte Carlo, except it's bigger.
Is there anyone we've forgotten to insult? I'll make sure we don't miss anyone here. Number 7.
I'm Tom Nelson from North Oaks, Minnesota. What are your thoughts on the issue of illegal naked short selling?
Well, as you may know, I have a friend that's been fairly outspoken on that, and from our standpoint, we have no objection to anybody selling Berkshire short at all. The more shorts, the better, because they have to buy the stock later on, and some of our shareholders may make some money lending. Charlie and I can't do it, but there's nothing I would love better if it were legal than to lend my stock to shorts and have them pay me something for doing it. I might want to get prepaid in certain cases. There's nothing evil per se about, in my view, about selling things short. I would say that it's a very, very tough way to make a living. It's not only often painful financially, it's very painful emotionally, because a stock that you sell short, a stock that you buy at 20 can go down 20 points, and a stock that you sell short at 20 can go up an infinite amount, and you don't think about that until you've gone short and it goes up about 10 or 15 points, and then you don't sleep very well. So it's a very tough way to make a living. There are people on the short side that have done and that do things to try to make stocks go down, some of which are appropriate and some of which are inappropriate. There are people on the long side that have done the same sort of things go on. So I don't see any. I have no axe to grind in the least against short sellers. And in terms of what they call naked shorting, which means that you don't have the stock lined up to be borrowed, and maybe you have a whole bunch of fails to deliver and that sort of thing. I don't have a great problem with that. If anybody wants to do that with Berkshire, they more power to them. Short sellers, the situations in which there have been huge short interests very often have been later revealed to be frauds or semi-frauds. Now, the one my friend runs is not at all, but the batting average, I mean, over the years, I probably had 100 ideas of things that should be shorted. And I would say that almost every one of them have turned out to be correct. And I'll bet if I'd tried to do it and make money out of it, I probably would have lost money. I would have had no fun, and the opportunity cost, as Charlie said, would have been enormous. Because if somebody's running something that's semi-fraudulent, they're probably pretty good at it, and they're working full-time at it. And they've succeeded for a while, and they may keep succeeding. And if they succeed and you go in at X and it goes to 5X, all you're hoping after a while is that it goes back to X again or something of the sort. It's a very tough psychological game to play. Few people may be well suited for it. I would never put any money with a short fund, but not because I would think it would be ethically wrong. I just think that they're unlikely to make money. Charlie, do you have any thoughts on short selling or naked short selling?
Well, I think you're absolutely right there in the sense that that would be one of the most irritating experiences in the world, to figure out something is crooked and foolish and so forth, and then short it at X and have it go to 3X. Now you're watching all these happy crooks splashing around in your money while you're meeting margin calls. Why would you want to go in hailing distance of an experience like that?
Well, we've hit 3 o'clock. We're going to adjourn until 3:15. We will then have the business meeting of Berkshire, and you're all welcome to stay. You're all welcome to shop. You're all welcome to enjoy Omaha, and thanks for coming.